topic is insight on investment behavior. Okay, let me tell you why I have selected this topic. See, the difference between you and your financial success is nothing but your own financial behavior. So your financial behavior leads to the financial success. That is what I say. See, if you set it in the right direction and from the beginning, then definitely financial success is ahead. So that is why I have chosen this topic, and it is very, very important. So it is not a rocket science. It is not a rocket science. It is very, very simple. Only thing is you have to think sensibly. That's it. Okay. So let's before going to investment behavior, let me start with why we have to invest, because from the basics I have to explain you. So why investment? Why investment? Because to generate future cash flow with enhanced purchasing power. About enhanced purchasing power, let me tell you in the later part. Okay, but what do you mean by generating cash flow? You have to invest money. From that source you should be able to generate flow, like cash flow. Say for example, you bought a agricultural land, you will be able to generate revenue from that, and thereafter. So it is an investment. So if you invest in equity, you will be able to generate through dividends. If you invest in real estate, as I say, you will be able to get it through rental income or any other stuff like agriculture income. Or if you invest in debt, you will get it through interest income. You'll get interest income. Okay. And one more thing is to get financial freedom. This is the thing you need to understand first, because it is very, very important. This concept is very, very important. Financial freedom is very important. What do you mean by financial freedom? It is a state where you need not work for money. You work because you want to work. You work just because you want to work, not because you have to work. Okay. So in this state, for your monthly expenses, you'll be able to generate that money without putting any effort. Say for example, I need 10-20,000 rupees per month for my expenses. I'll be able to generate that money without putting any effort. If I'm in that state, then I get, then that is the state. That state is called financial freedom. So first we have to generate future cash flow. That is why we invest, and to get financial freedom. How we can get financial freedom? We will not get it so easily. So we have to beat inflation consistently. So in India, let me tell you what is inflation. Today you go to a shop and you ask a chocolate, dairy milk chocolate, you pay 100 rupees for that. Next day you go to the same shop and you ask dairy milk, he says 110. 10 rupees is inflated now. So 10 rupees is the inflation rate, the rate at which the cost grows. So that is inflation. Okay. So we have to beat inflation consistently. If we see in India, if we consider India, from last 30 years, the inflation rate is around 9%. So only equity and real estate have beaten has beaten inflation consistently in India. Okay. So let's go to asset classes. What do you mean by asset classes? It is a place where we can invest. That's it. Simple. So if I have some money in my pocket where I can invest, that is asset classes. So what are those? Debt, equity, real estate, and gold. Okay. What do you mean by debt then? Debt in the sense, see, debt is in debt. The underlying instrument is nothing but loan. Say, for example, in bank fixed deposit, it is one of the debt avenue. So in bank deposit, what happens? Bank collects money from us and they lend it to others. Similarly, in debentures or any debt mutual funds, what they do, they collect money from us and they lend it to others. In debt securities, in corporate debts, they collect money from us and they use it for themselves. Okay. Sorry. So this is nothing but debt. And about equity is about ownership interest. It is all about ownership interest. Tomorrow if I want to buy some company, if I want to buy Reliance, I'll not be able to pay 18 lakh crores or 18 lakh crore rupees. I don't have that much money. So I can become the owner of Reliance just by purchasing a stock in the stock market. I am also owner. Ambani is also owner, but the difference is we don't have that much number of shares. He has more number of shares. That's why he is in that board. I am not in the board. Okay. And about real estate, as you know, Real estate is nothing but investing in land or any commercial properties from where we can generate yield, okay, from return. And gold, as you know, I don't consider gold as asset class, but most of them consider, because it is a sterile asset. It does not create any future cash flows. It just value of the gold appreciates, but it does not create any cash flows in the future. Value of it appreciates, so it is a sterile asset. I mainly prefer that's why mainly say these the above three are the asset classes, not the gold, but many of them considers. And if we consider in India, debt and gold have not beaten inflation consistently, but gold has beaten inflation consistently from last few years. From last, if we consider return of last 10-15 years, then gold has also beaten inflation. But from if we consider the past 30 years return, then gold has not beaten the inflation. So whereas real estate and equity has beaten. The main, all these avenues has advantages and disadvantages. Let me go to the real estate and gold first. Then my area of expertise is in debt and equity, so I'll go to it later. So real estate, why I don't prefer real estate? Because liquidity is the major issue. See, you'll not be able to sell it whenever you want. So if you want money, 10 lakh rupees tomorrow, if say you have a site in somewhere near your city, so if you want to sell it tomorrow, no one will be there to buy it. So and also you need a large corpus to purchase a land. It is if you want to buy a small piece of land, even 1 acres of agricultural land, you need 30 lakhs, 25 lakh rupees today. So it is which is a large, so everyone cannot afford it. For that, they might have to do loan, everything, and a whole life, throughout our life, we have to under the burden of debt. So that is there. So that is why I don't prefer real estate. And about gold, as I said before, it has not beaten inflation consistently. That's why I don't prefer gold much. So let me go to my area of expertise, debt. So what do you mean by debt? As I said before, they collect money from us and they lend it. So why we use debt in our portfolios? Portfolio is where our money is, like how we have constructed it. Our what do you mean? If my where I have invested, that is nothing but portfolio. If so, balance the risk of portfolio. Debt balances the risk of the portfolio. How? Because it is non-volatile. It is not fluctuating. You see, in bank deposits, it is not fluctuating. In the beginning itself, we know how much interest we are going to earn for this year, next year, and the next year. So that is not volatile. It is non-volatile. Of course, some little bit in debt mutual funds, little bit fluctuations will be there, but it is not volatile as equity. So steady returns, as I said before, from the beginning itself, we can predict in debt mutual funds or we cannot predict the returns, in the sense, of course, we can predict the returns, but assured returns are not there. But in other bonds or bank deposits, returns are mentioned in the beginning itself. So we can expect the return. What are the caution? Caution. There are two risks when it comes to debt. This is a disadvantage: interest rate risk and credit risk. What do you mean by credit risk? Tomorrow I give some money to so tomorrow Kishan Rao gave me some money and I am not giving back to him. That's a credit risk. So, and what about interest rate risk? Interest rate risk is like whenever the RBI changes the interest rate, it just affects the price of the bond, so that investor might lose. So that is interest rate. In that way, interest rate risk affects the portfolio. Okay, so bond prices fluctuates and hence it affects our portfolio. Okay, prefer bonds which so what are caution? Prefer bonds which has lower maturity period. So whenever you invest, right, always prefer the bonds which has a lower maturity period, because it has lower interest rate risk. Okay, so for example, in of course in bank deposit, it doesn't matter. In debt mutual funds, especially liquid funds, low duration funds, ultra short term funds, and max to max short term funds, after that, long-term bond funds has higher interest rate risk. That's why I don't prefer it. So lock-in bonds increases the liquidity risk. Lock-in bonds. So what do you mean lock-in bonds? See, whenever the company whenever some company want to raise money through debts, they have liquid lock-in periods for that. You will not be able to sell it for say 5 years or 10 years. Say some government free bonds are there, tax-free bonds are there, not free bonds, tax-free bonds are there. For that, lock-in periods will be there, 7.5 years, 10 years, like that it will be there. So it is like, say, you'll not be able to sell it even if you need it. So that's why you need to be aware of that while investing into debt. So let's go to equity. What do you mean by equity? As I said before, it is about ownership interest. So how your equity portfolio structure should be. It's I say this is not a perfect or a fantastic strategy. This is just a simple, decent portfolio structure, what I'm saying. So you have to invest in minimum 50 to 60 companies from 10 sectors. Okay, from sectors in the sense pharma sector or any in economy should depend on those sectors, automobile sectors, construction, many sectors are there, right? All those sectors you have to select, and you have to invest. Energy sector, like that, software, or like that. Okay, so select at least 5 to 6 companies from each sectors and invest in those sectors. Okay, so and those companies should be blue chip. What do you mean by blue chip? Best in class companies. See, I will not pick up the names, but you know, right? In software, what are the best companies? And what are in energy sector, what are the best companies? In FMCG, what are the best companies? In healthcare, what are the best companies? In painting industry, what are the best companies? You know, right? You know, right? So you have to select those companies and you have to invest in those companies. And if you want to go to equity, then you should be able to hold it for minimum of 5 years. Otherwise, don't go with the equity. Okay. So this is very, very simple. If you are investing in equity and debt, just you need to follow this procedure. And margin of safety, if I tell it in a technical aspect, mark index, this rule is given by Benjamin Graham, Warren Buffett's guru. He says market has to index has to fell 25% from last peak, and PE ratio has to be lesser than 19. But in simple terms, if I have to say, you need to have buffer when the market crashes. That's it. Okay, so whenever market crashes, you should be able to buy it, rebuy it. So that is why we follow margin of safety rule. So as I said, investment is very, very simple, but people will not be able to do this. Why? Let me tell you in the later part. I'll tell you. This is very, very simple, as I say. So you can construct your portfolio based on, you can take guidance from any investment advisor or financial planner, or you can study yourself. In history, a lot of studies have conducted on asset allocation, but I cannot, it depends on individual. So but in general, people say 40% into debt and 60% into equity is ideal, like in the best risk, it gives best risk adjusted return. So people say like this. Okay, but people will not be able to do this. Let me tell you why. Okay, before telling why, we have conducted a survey. Out of that, so the result has come as I expected. Most of the gave first preference to real estate, most of the docs and medicos, and second preference is to like debt, then gold and equity. 83% of people have not preferred equity. Only 17% have given first preference to equity. So it is same with almost everyone, Indian mentality, but that is due to lack of knowledge. So let me, 1 minute, this slide is, yeah. Let me come to this slide. Warren Buffett says investing is simple but not easy. Why? Because our own financial behavior will not allow us to implement our plans and achieve our financial goals. That's it. So, and also human beings are very greedy. That's why we will not be able to achieve our goals most of the times. So these behaviors, these biases, because of these things, we will not be able to achieve that. I said investment is very simple. If you do that and if you stay the course, then definitely you will be able to achieve in your financial freedom in 15-20 years. Okay, but you will not be able to do that because your own these financial behaviors affects your financial success, your plan. Okay, so let me explain it one by one. What are these? Okay, Sorry. Financial behavior, loss aversion. See, these behaviors are not rocket science. This is very simple. If you invest, you will experience this. Okay, so this is not complicated. This is very simple. Loss aversion is nothing but fear of losing money. Say, oh, my father says, oh, what, it is very risky, I'll not invest into, I invest in stock market. Why he says like that? Because he does not know it. Okay, why, what happens? Because they don't follow the rules. Somebody in the market has gambled and did the trading and lost a lot of money. Because of that, people say, okay, it is a risky, I don't prefer a stock market. Because it is fluctuating, I don't prefer it. That's why people hesitate, because of lot of reasons. Okay, investor, because of this, people tend to prefer fixed income stock investment rather than stocks. This we know. See, in the survey also, many people have said debt is their first preference. 27% of them have answered like that. Why? Because it is nothing but loss aversion. They feel it is not safer. Investors tend to realize their gains early stages, so they will simply withdraw their money once they get 100% return, or simply like that. They will not allow their money to get compounded, so they will withdraw it early stage. So at the early stage, and investors take more risk when they are threatened with the loss. This also happens. See, if somebody has fell in love with some of the companies, and they will simply repeatedly they goes on purchasing the stocks. That is not because of loss aversion. That is because of the endowment effect also. That also I'll come, but that is also one of the reason. So they say this company is going to do very great, so if I repurchase it, even if it goes up again, it will go up, and they think it will go up, and they'll take more risk. Okay, so because of this, they take more risk. So these are the impact of this loss aversion. So we have to keep it in our mind while investing. We should not worry about the stock market. It is like a heartbeat, it goes up and down. We have to keep it in our mind, so that we will not get out from the market. We will stay the course. Sunken cost fallacy. If you see, if you analyze yourself, you might have done this before also. See, let me tell my example only. uh, uh, I had one laptop, Asus laptop. So after 4 years, 5 years of purchasing, the screen got damaged, and I gave it to service center, and they changed it, and it cost around 5,000 rupees. Again, after 2 3 months, its keyboard was gone. So again, I spent around 2,500. So what I did, I spent, see, because recently I have changed the screen, right? That's why again I didn't want to change my laptop, so I changed the screen board. Again, after 3 months, the battery was gone. Again, I spent 3,000, and finally I changed my laptop. But why? Because to justify the past action, I simply overspent, spent the money. This is why this happens in equity also. Averaging the cost of purchase, you feel that, oh, this I have purchased before, I have invested 1 lakh rupees, there's again I will the money should not lose, I will again invest, like that you think. So you think it will go up because your ego is tied to that, because you have invested, right? That's why you think it goes up. That's why you again purchase it. So it happens like that. So government spending on unviable project. Anyway, we have seen many government projects simply just because the previous government has spent, and even if it is not viable, government will spend on it again, because they think we have already spent so much of money, why not to waste, so let's complete the project. That's what they think, even though it is not viable. So this is nothing but sunken cost fallacy. The term might be complicated, but the simple things, these are very simple things. So endowment effect. What do you mean by endowment effect? The tendency to fall in love with what we own and thus resist the change. So what we do, if we fall in love with one company, we tend to overvalue it. We just exaggerate it. We think it's a great company. We will explain to with everyone, and we will ask everybody to invest in those companies. We fall in love with one company. Okay, we will resist the change. What is the example of trial and money back guarantee schemes? In some of the websites, they give for free trials. So once we use that, we will resist the change. So we pay money and we subscribe it. That's what. So we should not do that. If it is really necessary, then we can do. That's okay. But irrationally we do that. Simply, even though some apps, even if I don't need it, I will first I'll use it for free trial, and again I'll pay money and I'll buy it, even if it is not useful. And confirmation traps while investing, no, we think that, oh, somebody is some expert, we will ask his confirmation even though if we study. So so all these biases, we should not affect by these biases. Okay, so we should keep it in mind. Next comes to status quo bias, our inability to make decisions while investing. We feel like we will not be able to take decisions. Why? These are the four major reasons from the studies. So fear of going wrong. What if I go wrong? That's the first question we ask ourselves while investing. Possibility of losing. What if I lose money? To avoid looking foolish, hey, he should not laugh at me. So that's what we think. Unwilling to take a risk. So this is nothing but loss aversion. So we don't take risks. These are the major four reasons. That's why we don't take decisions. Sometimes you need to take decisions while investing, so that you will be able to get the compounding effect of a stock or any investment. And mental accounting, this is very, very important. Tendency to place different values to the same sum of money based on how it has been acquired and the effort required to acquire it. This is simple. Say my one of my friend gifted some money to me. I'll spend it, say 1 lakh rupees, or some big close friend, and he has just gifted. He has good large corpus, and he just gave me small amount, 1 lakh rupees. So I'll enjoy it in a different way. If that is my hard-earned money, I'll use it in a different way. We give different values to the same sum of money. See, earned income versus gift income, and credit card versus cash. See, when you use credit card, then you'll not that will not pinch you while paying money. If you are paying through cash, that will pinch you. So you try to give money, try to spend with cash always. Without, if it is better not to use credit card. Of course, if you have money, you can use credit card. I'm not against credit card, but the pinching is more compared to credit card in cash. Earned income versus large purchase versus small purchases. See, in recently we had some construction in our home. We have spent a lot of money. So while purchasing items, we used to think, oh, this cost only few thousands, or anyway we are spending a lot of money, that's why let's spend again. So you should not do that. This is about financial behavior. This is what I'm talking. So never always treat money as money. Never underestimate it. Like, even if it is 1,000, treat it as money. Even if it is 1 lakh, treat it as money. Okay, so this helps you. Mental heuristic. Our brain takes shortcuts while processing information, which leads to biases. This is very very important. What is the availability heuristic? Let me tell you. You take decisions based on the recently available newses, based on it is like halo effect. You give preference to the recent newses, or halo effect is you are giving preference to one single incident, or based on that you take decisions. So you think that some X company has this and this facilities, and so much of they have invested a lot of things in innovation and all. You, based on that news, you will invest into that without thinking about the fundamental futures, anything, future plans, everything. You will simply invest in that company. You don't do that. Okay, representative heuristic. What people do is, if some company from some sector has done very well, then they think that this sector is going to do very well. Simply they pour their money entire into that sector and they lose their money. Okay, that is very, very dangerous. And saliency heuristic. It is like availability heuristic only, but not little different. You take decisions based on the unusual events. Like, say for example, if some company has done exceedingly well in a quarter, recently quarter, you think that this is going to represent for the next, this is going to happen for the next few quarters, next many quarters. That's why they invest. It need not happen like that. Okay, so overconfidence. You always say I have invested in company X, you think that this company is going to do it. You will have that overconfidence while investing. Don't have overconfidence. Okay. So herd mentality. Just because we know that said some company is doing good, you think it is going to do well. So hard, just because people have purchasing a lot of stocks in the market, you also jump into that, jumping to buy that stock. That is very, very dangerous. Okay. So you need to keep these biases in your mind. You will do this if you are already investing. You have already experienced this. So these terms may be complicated, but the process is very simple. Just have to stop it if you are doing it. And let me come to the where not to invest. Okay. Where not to invest is an important part. Insurance. I have mentioned insurance. Why insurance? See, insurance, of course, everybody must have insurance. It should be a pure term insurance. See, if some why insurance, why we need to put our money into insurance? Because if something happens to the breadwinner, his or her income has to replace to the dependents. So but what is happening now? People are coming to our home, or we are going to somewhere. We are seeing some advertisements that we are going to get this much money, and we simply invest. But we are not going to. We are going to lock our money, and we are not going to get good returns also, which beats inflation also, which doesn't beat inflation. So that's why I don't prefer insurance as an investment. It is a risk management tool. By definition, it's a risk management tool. Okay. So have pure term insurance policies, but not endowment policies or any money backing policies. Okay. So trading, I am much against trading. Why? Because many people have lost their money. It is very, very difficult to predict the market in the short run. In the long run, it is relatively easy. We can say economy is going to do good, and stock market, we can predict that market also will do good in the future. But in the short run, it is very, very difficult. And also cryptocurrencies. Nowadays it's a fancy, like many people have started investing into they think that they're investing in cryptocurrencies. Please note, currency is not an investment tool. It is a medium of exchange. So and cryptocurrencies, they doesn't have formal nature of the currencies also. It fluctuates a lot. See, if I go to a restaurant, after half an hour, the value of my currency might be half. Like if I have 100 rupees in my pocket, that after eating it, the value of the paisa will be half, like 50 rupees only. So that is not the nature of the currency. So it is very difficult to replace. Cryptocurrencies are like it is very difficult for them to replace normal currencies. And also it has no fundamentals. See, equity, it is about ownership, and real debt, it is about a loan. And gold is also there for ornaments or any ornaments. And real estate, of course, land is there. But in cryptocurrencies, nothing is there. Okay. Cheat funds, there are many people who invest, who put their money into cheat funds. The hell lot of people have lost their money. It is designed to fail, actually. See, in some of the people, see, it's a group of people invest some money on a regular basis for certain, say for example, for a group of 40 people investing 10,000 per month for next 40 months. So it is a group of, in this example, it's a 4 lakh chit fund group. Okay. First month goes to some people, and yeah, in the second month, those who are in bad shape of economy, those who are eagerly want their money back, they simply leave the money. Say they assure that they will pay 10,000 for next 40 months, but they want to withdraw 2 lakhs now itself. We just leaving 2 lakh rupees to others. So it is designed to fail. Okay, so never ever invest in cheat funds. Okay, it is not regulated also properly. And cooperative society deposits. See, cooperative societies, why I am saying cooperative society deposits are riskier. See, while in cooperative societies, even those who take loan, they get voting rights. Whenever they see, if they get voting right now, they will vote to the person who give loan easily. Okay, that itself simply increases the risk. If they if they give person to if they vote a person who gives a loan easily, then that person may not be following the rules of the lending. He may be breaking the rules of lending. So that is a problem. So risk is very high in cooperative deposits, cooperative society deposit. Any type of gambling, Dream 11 or any bettings, I don't prefer. You don't think that it is a investment at all, it's a gambling. Okay. Chain linked schemes. What do you mean with chain linked schemes? You have to add, you will add one person, that person will add another two persons, and the chain goes on like that. So if you want to get the best example for this, just search Ponzi scheme, Charles Ponzi, who has done this. Just search that in Google, you will get it. So this is very, very bad. So you don't invest in these places. Okay. And about conclusion regarding this, yeah, see, whatever I have told till now is very, very simple and easy. Not easy. It is very difficult. So it is very simple to understand. It is very difficult to implement it. Okay. If you are investing currently, then you will experience it. So capital safety should be the first preference. Always give first preference to the capital safety. Never forget about it. If you don't have the capital, it will not build any wealth to you. Okay. So never forget about liquidity. From this session, we have to keep it in our mind. So as a student, you have to keep it in mind that, see, always whenever you need money, you should be able to sell it, or you should be able to get it. You should be able to sell the security, and you should be able to get the money back. Okay. Save minimum 30% of your income. See, most of the people will not do this. In a survey also, of course, many students who have answered, they may not be having that much of income, good decent income, but please understand, try to save 30% of your take home. Then you'll be able to get your financial freedom early as possible. Reduce your debt. It is very simple, right? Reducing debt is not simple. I mean, the concept is very simple. So reduce your debt. Never if debt is there, that itself is a burden, right? You have to work. And invest early, invest regularly, and invest for long term. Always follow this mantra. Always, yeah, as a student, you have to follow this. You always have to invest early as much as possible. Even if you are a student, try to save it. See, let me give my example. I have started my engineering in 2012 and finished it in 2016, and in 17 I've started my PGDM and finished in 2019. So if I started a SIP of 2000 rupees per month, even if it is a 2000 rupees per month, the value of that into equity, then value of that fund might be around 4.5 lakh rupees now by this. So where is 2000 and where is 4.5 lakh? So always invest early. Okay. And invest regularly. Why invest regularly? Even if the market fell, even if the market crashes, then the price of the security will be averaged, and you'll be able to average it, and when the market goes up, your value goes up. Okay, your investment value goes up. And invest for long term. See, why invest for long term? Always, every business cycle has, in India, in India market, we say market will be booms and busts in the market will be over in 5 to 7 years. That's why we prefer, if you are going to equity, minimum you hold it for minimum of 5 years. Okay, otherwise don't go for it. So invest early, invest regularly, and invest for long term. And simplicity should be our style. This is very, very important. We should be simple as much as possible. We should not show off for others. Okay, so we should not buy things just to show off with others. So that is very, very dangerous. Even if you get 3 lakh per month, even if you get 10 lakh per month, even if you earn 15 lakh per month, you will not get financial freedom, because your simply your standard of living goes on increases, and you just have to goes on working like until the age of 70 or 80. I have seen many people who worries about their future at the age of 65. So that is why I always say, try to plan for your retire as early as whenever, from the day one you plan for retirement, and also plan for your investment. So this is about investment and financial behavior, and I hope Yeah, 7. Yeah, I Kishan has told me in 45 minutes. He has given me 45 minutes time, and yeah, my session is over. Yeah, one person has asked about what about network marketing. Can you brief it once again? Like, network marketing is nothing but chain link schemes, right? It is, but we have to think about the product. What is the product there? There are like Amway products. Product might be good, but I have seen some of my friend were giving me session. They were saying I have to invest 3 lakh rupees, and I have to bring another 2 more people like that. That is very, very dangerous. So just uh, think about that, okay, before putting your money. I hope I have answered that question.